From Rea Associates Studio, this is Unsuitable, a management and financial services podcast for entrepreneurs, tenured business leaders, and others who are ready to look beyond the suit and tie culture for meaningful, measurable results. I'm Doug Hauser. On this weekly podcast, thought leaders and business professionals break down complicated and mundane topics and give you the tips and insight you actually need to grow as a leader while helping your organization grow and thrive. If you haven't already, hit the subscribe button so you don't miss future episodes. And if you want access to even more information, show notes, and exclusive content, visit our website at www.reacpa.com/podcast and sign up for updates. No time to sit back and relax because decisions on tax planning are still in play. With the 2020 elections approaching and the uncertainty of COVID-19 continuing for who knows how long, we can expect to see new legislation and tax-related provisions in the works. Today, Chris Axene, principal at Rea Associates, is going to share some of the decisions we can expect to see from the Supreme Court, as well as some questions you should consider asking your CPA during an election year. Welcome back to Unsuitable, Chris.
Thanks, Doug. Glad to be here.
Glad to have you on as always. I think you might be approaching the record for most guest appearances on Unsuitable.
Really?
So,
Do I get a prize for that?
Well, maybe a drink from the host. How about that?
Perfect.
So,
I'll take that.
Yes, we'll have to do that. Hopefully we can do this again in person here sometime soon. But
I agree. I miss the in-person podcast experience.
Yes, absolutely. But yes, let's start with the Affordable Care Act. Obviously, that's been challenged through the court systems. Currently awaiting a decision from the Supreme Court. Correct on that?
Yeah. So a bit of breaking news, I suppose, related to prior years that I wanted to bring up to our listeners here. So the Supreme Court has agreed to hear a lower court case challenging the constitutionality of the Affordable Care Act and everything that goes with it. They announced that a month or so ago, and they'll be hearing that case in their October term. So starting in October, the outcome of that, will be sometime after that in terms of an up or down on whether the Affordable Care Act will stand, as enacted or be struck down.
Yeah.
So what that does is there's potentially an opportunity for many of our clients and listeners here on the podcast because, as you may know, the Affordable Care Act was passed for basically universal type healthcare, and the pay for to cover that was in the enactment of a couple surtaxes. One on so-called net investment income, 3.8% surtax. So that's on interest, dividends, cap gain for certain taxpayers that are over the threshold in terms of when it applies.
Right.
And then the second piece was the Medicare surtax, 0.9% on wage and self-employment income that's above the threshold. And so Affordable Care Act was first enacted, I think, in 2010, and then fully phased in, maybe 13, 14 timeframe. So clients and taxpayers in general that have paid these surtaxes in the past may be eligible for a refund opportunity if the Supreme Court rules that the Affordable Care Act is unconstitutional.
Interesting.
So what happens is of course, tax returns have a 3-year statute of limitation in terms of years that are open.
Yeah.
And right now, there certainly is a segment of taxpayers that extended their 2016 returns and they may have filed them in, let's say, September or October of 2017. And so that 3-year statute is coming up and will expire. And so the opportunity here in the short run, next 60 days, let's say, is to file protective refund claims if you've paid a significant amount of either of those two surtaxes for that 2016 year, to maintain your rights to a refund if the Affordable Care Act is struck down.
Wow. Yeah, and that's obviously that would be quite messy going back that that far, certainly.
Yep.
So can you speak, Chris, in general terms about the threshold for taxpayers that paid each of those surtaxes?
Sure.
The 3.8% on net investment income, roughly, where was the threshold on that?
Yep. And so the line in the sand, so to speak, would be for married filing joint that had their adjusted gross income was over 250,000, and
Hmm.
then for single taxpayers it was $200,000. Above that, then you could start to pay either of those two surtaxes, and it's the same threshold.
That's certainly interesting. Of course, there's many other things that go along with that. The pre-existing condition protections and things like that, which would go away. So
Yeah.
certainly more to come on that. But you said there's no decision certainly expected prior to the election. Is that correct?
If I were a betting man, I would bet that we would not get anything prior to November 3rd, and quite frankly, it may come out, after the end of this year, maybe early January timeframe.
Yeah. And of course, the legislative environment could change entirely in that time frame, right?
Yep.
So who knows? But yeah, that's a great, obviously, planning advice for folks. So the message there is get with your tax professional here soon to protect that that 2017 tax year, correct?
2016.
2016
Yep.
that might have been filed.
Yep.
Yeah.
And then we've got a little more time for 2017, and of course 2018. Those that 3 years, we are a couple. What I would expect there is maybe the 2017, for those that would have timely filed, that would have been by April 15th of 2018.
Okay.
And so if we get a decision there in January, February, then 17 will know, what our options are at that point.
Yeah. Now, what about some of the other the CARES Act, COVID related stuff that we've seen this year? Can you talk a little bit about the impact there and what folks should be thinking about
Yeah,
at this point in
absolutely.
time?
So, I wanted to remind our listeners about some opportunities that Congress passed already with the CARES Act that are applicable to, 2018 returns, 2019 returns, and potentially 2020 returns. The biggest of which really is in two areas, but it gets all to the net operating loss deductions.
Hmm.
So I guess the first thing to bring up is our listeners may have been aware that when the so-called Tax Reform Act was passed and effective for 2018, there was a glitch. They called it a so-called retail glitch with leasehold improvements to real property and the ability to take bonus depreciation at 100% in the year of purchase.
Hmm.
That finally got fixed with the CARES Act, retroactive to 2018, and so that makes a big difference because in the absence of fixing that, we had to depreciate those improvements straight line over 39 years,
Right.
Which is a significant difference in terms of a deduction.
Right.
So that got fixed. So if we had, and we did have clients that, we took the position at the time, particularly with regard to 2018 returns, was, it hasn't been fixed, and this is what the statute says, and so we have to go with 39 years straight line, and now we can fix that. And clients have a variety of options to fixing it, whether they want to actually amend a 2018 return, or if they can fix it on their 2019 business returns or individual returns if they haven't been filed yet.
Right.
And so what that can do in and of itself, or is it can create a net operating loss. And so that's really one of the other big things with the tax side of the CARES Act, was the ability to, for tax years 18, 19, and 20, if the business generated a loss, you could carry that loss back up to 5 years.
Right.
Under tax reform, the Congress had eliminated that carryback. It used to be 2; they got rid of it, and there were some significant limitations on the use of that going forward. And then the CARES Act came and fixed that. So there's opportunity. Right now, let's stick with individual taxpayers. The top individual tax rate is 37%.
Hmm.
If you have a business loss that you can carry back to 5 years, you'd be going pre-tax law change when the maximum tax rate was 39.6%. So there
Right.
definitely is an opportunity there to get some higher dollars back if you find yourself in an NOL situation.
So it's nice to try to take advantage of those while you can, certainly, because those winds may blow the other direction before too long, right?
That's right. And just, on the corporate side, I think the difference is even bigger. Corporate tax rates right now are 21%
Hmm.
starting in 2018. Prior to that, most C corps paid a 34% tax rate, but the really big ones could be at 35. So,
Yeah.
again, some significant dollars. And when we're in, still feeling the impact of COVID on the economy and business owners, cash flow is important, and this is a way to reclaim tax dollars that you paid in the prior year.
Yeah, absolutely. And I think of it another way too. And I've gotten this question, had this discussion a lot with a fair amount of construction clients who've continued to perform well during this time frame. So, they're used to always be this consistent thought. Well, I want to try to defer my tax burden as much as I can, that type of thing. But given where rates are now, as you said, so low on the corporate side, and with all kinds of government entities, be it federal, state, local, seeing these massive revenue shortfalls that they're going to have to try to recover in some way. The likelihood of future tax rates being better than they are today is probably pretty low. Would you concur?
Yeah, the way at the rate we're printing money, the outlook is not good for low rates.
So, given that, if we expect perhaps future rates, whether they're capital gains, ordinary income, whatever, that more likely than not may be higher, what does that do from a tax planning perspective? Does that change the thinking right now? What do you advise at this point?
Sure. Yeah. So tax planning in an election year is always a shot in the dark
Mm,
in many respects, particularly when we're sitting here in August and we're still waiting to have our election on November 3rd. Typically, you don't get changes to the tax law prior to November 3rd because nobody, the incumbent generally isn't going to, you know, try to enact anything. They're going with what got them here, so to speak. The other side, may or may want to go out on a limb to create something that can be held against them,
right.
and advertising by their opponents. So it's rare to see any meaningful tax legislation prior to November 3rd in an election year. This year, because of COVID, and really from my perspective, entirely because of COVID, I guess I wouldn't be surprised if we got something, just because you know the different areas of the country continue to be impacted differently
Mm,
by the pandemic. You've got, particularly in the retail or restaurant sector, that, again, is being impacted because of early closings and,
yeah.
their inability to get large groups to buy from them. That you could see something happen, and they would have to happen in September or October, to try to pass something tax related that is also COVID related.
Yeah.
Absent that, what I counsel to my clients and for the good of our listeners is, tax planning in an election year is be flexible, maintain the flexibility as much as you can, so that after November 3rd, when now we kind of have an idea, or we will have an idea of what Congress looks like
Hmm.
and what the White House looks like, and if and what impact that may have on taxes going forward.
Yeah.
um, and at this point, if since we know President Trump is running against Joe Biden, if Biden wins, and if Congress, the Senate, changes hands, and let's say the liberals control both parties in Congress and the White House, I think you alluded to earlier, taxes are going up. And so when taxes go up and we know that that's what we have in our future, then we try to do things to push off deductions and accelerate income to the
Right.
extent that we can into, probably at that point, a month and a half in 2020.
Yeah. It'll be a crazy time. I mean, I even think of, in my world related to construction, I was on a conference call a short while back with Jack Marchbanks, who's the director of ODOT. Of course, all of the road projects in Ohio are separate from the general fund. They're entirely funded by um, the diesel tax, the gas tax, and as well as contributions from the federal government. But question came up: well, how are we doing on diesel tax collections? What does that mean for future road projects? All that. Now they were flat at that point. This was maybe 45 days ago. Year over year, they were flat. But the only reason they were flat was because we had a significant increase in that tax that was finally passed first time in 20 some years last year. Absent that, they would have been down significantly. So, of course, they're very well below projections, and then that impacts the ability to fund those infrastructure projects. So, question then becomes, well, if we're still in this crisis, things like that, habits don't change immediately. How do we alter the different taxes that we have based on the current environment and usage that we see? So I think there's a lot of those kind of discussions, a lot more going into it at all levels because behaviors have changed, right? And how does that impact potential the tax code going forward?
Absolutely. I was reading something over the weekend about the bed tax, the
Hmm.
occupancy taxes and hotels here in
Yeah,
Columbus. And, my numbers, take them with a grain of salt. But the context of the article, as I recall it, was in general, in, year to date, that there might have been something like 30 million of taxes collected in occupancy related, bed tax at
yeah,
hotels. And year to date, it was like 2 million.
wow,
Um,
yeah. And some states, right, don't have an income tax. They rely more on higher sales taxes due to
property
tourism and
taxes,
things.
yep, etc.
Yeah.
Yep.
So states like Florida could be impacted completely differently, right?
Absolutely. And the conundrum in tax law and so we have a progressive tax system and we want to tax those that make more. When you have times like these, though, in some industries, an income tax when you don't have income doesn't raise any revenue.
Right.
And then you get into the kind of the quicksand of, well, state and local governments need revenue, and do we raise sales tax on things?
Yeah.
And that disproportionately may impact a group of people that isn't where you want,
Yeah.
because it's a transaction type tax. And so it certainly is not easy.
And therein, that's the difficulty at the state and local level too, right? Because most of them have balanced budget requirements.
Correct.
So they're forced to deal with that in some fashion, whereas the federal government can sort of punt it a little bit.
Unfortunately, that's true. Yep.
Yeah. And various industries obviously impacted very differently too. I mean, think of oil and gas and what's happened there and how that trickles through those economies where that's a focus.
Right. Yep.
And where do we go? So a lot of questions. What if you're the typical owner managed business, okay, and your business is doing okay. You've had obviously just all the unknowns we face this year and going forward. What are some questions they should be thinking about and asking as we get into tax planning season here in the fall?
Well, so what I would suggest is make a date with your CPA if you have it. Some clients, they dread interacting with their CPA. They liken it maybe to going to the dentist. And from the other side of the table is we can only be as effective as a planner as the business owner is willing to share where they are in their business and what's going on and what's impacting them. And if there isn't that good two-way dialogue, then there's we're not going to be very effective to help them out. So, make a date with your CPA, either, over Zoom or, socially distant, whatever, and have those conversations about, okay, what's 2020 look like? Let's assume that the 2019 we filed, it's in the books, where 2020, okay, this is the year that COVID, has hit. We likely have an impact on our business. What are the options, that are out there based on what the business owner is seeing and the prospects for the rest of their year? And and then hopefully your CPA is talking to you about, again, some of the things we've covered at really high level in terms of cash flow items, because ultimately the business owner, they need cash.
Yep.
And so many things in the tax code are, in order to get a benefit, you got to expend money.
Mm-hmm.
And so it's when you get an opportunity like net operating losses and the ability to carry those back for 5 years where that didn't exist previously, that, that's an opportunity that you want to make sure you take advantage of.
Yeah. And as you say, cash is always king. So that's imperative. But I think that's sage advice, get in front of your CPA, have those conversations. So, we can be as informed as possible and help you make some of those decisions. And like you said, keep that flexibility, sort of hedge maybe a little bit, because we don't know so many things.
Yeah.
Well, Chris, I got to say too, I love the treetop shirt today. Very, very well done. And we got to get back out on the golf course, since last time we played, I think you took $4 off of me. So
well,
I want that back.
I need to give you an opportunity to win it back. And I played on Tuesday, and you would have won your money back if you've been playing.
Well, you never know. Hopefully we can, let's try to do that soon. That would be fun. So
Absolutely.
Before we get into the fall too far. Well, thanks again, Chris. Really appreciate you being on. And certainly if you want more business tips and insight, or to hear previous episodes of Unsuitable, visit our podcast page at www.reacpa.com/podcast. And while you're there, sign up for exclusive content and show notes. Thanks for listening to this week's show. Be sure to subscribe to Unsuitable on Apple Podcasts, Google Podcasts, or wherever you're listening to us right now, including YouTube. I'm Doug Hauser. Join us next week for another Unsuitable interview from an industry professional.